I'm Larry Walther, and this is principlesofaccounting.com, Chapter 5. In this module, we will continue with our discussion of purchase recognition issues for merchandising businesses, specifically focusing on income measurement and reporting. This is an important module because it draws together a lot of information you picked up in the prior videos about recording purchases and freight and discounts and so forth. So we need to review the net purchases calculation. Purchases are the total invoice amounts of all goods purchased during the period. Freight costs are deemed to increase the net amount of purchases, and purchase discounts and purchase returns and allowances are considered to be decreases in determining the amount of net purchases. Here we have a very important calculation. Focus closely. The gross purchases during the period, $400,000. To that we're adding $40,000, the amount of freight in that was incurred during the period, giving us a subtotal from which we subtract our various discounts and allowances and returns, coming up with the net purchases amount. This net purchases amount is going to be vital in considering the calculation of cost of goods sold and gross profit, as we'll see momentarily. The net purchases reflect actual costs that are deemed to be ordinary and necessary to bring the goods to their location for resale to an end customer. Items such as storage cost, insurance, interest, and other similar costs are considered to be period costs. They do not attach to the product. Those costs are expensed in the period incurred as operating expenses. Turning to the consideration of cost of goods sold, the cost of goods sold is the amount of the cost attached to the goods that were delivered to customers. This calculation requires consideration of all purchases as well as changes in inventory during the period. We need to consider beginning inventory as well as purchases, as well as goods that remain unsold at the end of a period. Those goods that remain unsold at the end of the period should not be included in an expense calculation. They're ending inventory, and we'll see this calculation. So we have beginning inventory, an assumed amount in this problem, to which we add the net purchases that we calculated in a previous slide. That gives us a subtotal we call cost of goods available for sale, from which we subtract our ending inventory. The valuation of the ending inventory is determined by a physical count and a reference to the cost of the goods using various inventory costing methods that are discussed in a future chapter. So we're going to take it as a given for this point. If we subtract the ending inventory from the goods available for sale, then the difference is what we assume to be sold or the cost of goods sold. Let's look at this graphically. Here I've got beginning inventory plus net purchases. That's a subtotal amount. Those amounts are derived from the general ledger. We have a carryover balance in inventory from the prior year, as well as our net purchases during the period by reference to the various accounts, purchases, freight in, purchase returns, and so forth. That cost is allocated to cost of goods available for sale, which in turn is determined to either be ending inventory at the end of the period or cost of goods that are sold during the period. Let's close this particular video by looking at a detailed income statement for Bill's Sporting Goods. This particular screenshot on the left is the actual income statement. On the right, I'm just showing some detailed calculations so you can find these critical numbers within the income statement. Here, first of all, look at the revenue section. We have sales, less sales discounts, and sales returns to come up with net sales. The next section of the income statement is the calculation of net purchases. This is really exactly like on the previous screen where we have purchases plus freight in minus our discounts and returns. So we have $420,000 of net purchases. And continuing on, the net purchases are added to the beginning inventory, giving us the goods available for sale, $535,000, from which we subtract the ending inventory, $91,000, and that gives us our cost of goods sold of $444,000. And cost of goods sold, you know, is subtracted from net sales to come up with the gross profit that can be seen on the left, $296,000. Lastly, we would have all of our other operating expenses that are subtracted to come up with the $11,000 of net income. As I close, I would point out one last time that freight out is not a cost of purchases. It is a selling expense to be included below gross profit in calculating the final net income number of the business.